When you look at a healthy stock market chart, there's this expectation of, well, a rhythm.
Right, like a pulse.
Exactly. It's supposed to look a bit like an EKG, a steady heartbeat of ups and downs, inhaling and exhaling. Buyers come in, sellers take their profits, and the line charts this jagged, somewhat predictable path across the screen.
Yeah, that's the normal behavior you'd look for.
But then you pull up the data for the semiconductor sector in April of 2026, and that EKG needle violently snaps and just pins itself to the absolute top of the paper.
Oh, it's completely wild to look at.
It is literally a vertical line. So today, we are decoding a massive stack of April 2026 market data. We need to figure out if this unprecedented 17-day vertical streak is a sustainable paradigm shift in how we value technology, or just the very top of a highly precarious bubble.
And for anyone listening who's trying to manage their portfolio, getting this right is absolutely crucial.
Okay, let's unpack this because numbers this big start to lose their meaning. Just how historic is this run we're looking at in the sources?
Well, to put the sheer scale of it into perspective, we have to isolate the Philadelphia Semiconductor Index.
The SOX index, right.
Exactly, usually just called the SOX.
Yeah.
It's the definitive barometer for the global chip industry. From March 31st to April 23rd of 2026, the SOX logged a 17-day consecutive winning streak.
17 days straight of just going up.
Yes.
Yeah.
And in its entire 32-year history, which covers the birth of the internet, the smartphone revolution, the cloud computing boom, it has never done that.
Never.
Never. The absolute maximum that it ever managed before was a 15-day streak.
I was actually looking at that old 15-day record in the research notes, and the contrast is what really grabbed me because a streak just tells you how many days the market closed green, right? It doesn't tell you how much money actually changed hands.
That's a great point.
During that old 15-day record, the index gained about 8%, which, that's a great month for any portfolio. But during the 17-day run in April, the index ripped upward by 40%.
40% in less than 3 weeks for an entire sector index is it's a statistical anomaly. It fundamentally reshapes the entire financial landscape.
And it gets even wilder when you zoom in on the specific exchange-traded funds, the ETF.
Oh, the fund flows were staggering.
The iShares Semiconductor ETF, ticker SOXX, went from around $310 a share straight up to $441.
Wow.
That's a 42% jump. The sources highlight that as the single biggest monthly gain in that fund's 25-year history.
And we should note, this wasn't happening on low volume either.
Not at all. There was a staggering $3.4 billion of inflows into the VanEck Semiconductor ETF, SMH, and an absurd $20.5 billion flooded into SOXX in April alone.
In just 1 month.
Just April. But here's my pushback. Looking at those numbers, is this just blind institutional scale FOMO?
What do you mean?
Well, think of a marathon runner. If they've been running at a phenomenal record-setting pace for 20 miles, and suddenly they decide to sprint the final 5 miles at top speed without breaking a sweat, you'd look at that and say, well, that violates the laws of biology.
Right, they'd collapse.
Exactly. So, does a 40% jump in 17 days violate the laws of finance?
What's fascinating here is that the underlying mechanics of this sprint are fundamentally different from what you might expect.
How so?
If this were just 1 or 2 AI darlings, say, NVIDIA or Broadcom, pulling the entire weight of the index on their shoulders, your marathon analogy would be spot on. They would eventually collapse from exhaustion.
Because they'd be overvalued.
Precisely. But the data reveals this rally has completely broadened out across the entire semiconductor ecosystem. Think of it less like a single runner sprinting and more like building a new metropolis.
A metropolis.
Yeah. Up until now, the market was really only paying the visionary architects designing the AI city. But in April, the market suddenly woke up and realized that to actually build this city, you have to buy millions of tons of concrete, steel, and copper.
Ah, so the money flowed outward to the raw material suppliers of the digital age.
Exactly. The foundational layer.
So if the rally has broadened out to the entire ecosystem, we have to look at the catalyst. Who is actually funding the construction of this AI metropolis? Because, you don't get $20 billion flowing into an ETF just from retail day traders.
No, definitely not. The demand is being driven almost exclusively by the bottomless checkbooks of the hyperscalers.
You're talking about Amazon, Meta, Microsoft, and Google?
Yes, the big four. They are currently locked in this existential AI data center arms race. Their capital expenditures, their CapEx for 2026, are projected to reach Hundreds of billions of dollars.
Hundreds of billions just
Yes.
on infrastructure.
It's mind-blowing. They are literally dictating the growth rate for the global chip industry right now because their mandate from the top down is to buy every single piece of compute infrastructure they can get their hands on.
I was digging through the Gartner projections in our research stack, and the numbers look almost like a typo.
They really do.
Gartner is predicting that global semiconductor revenue will hit $1.3 trillion in 2026.
Trillion with a T.
Yeah, that's a 64% year-over-year jump, which the sources note is the largest increase in 2 decades. But my question is, where is the physical ceiling on that?
What do you mean by physical feeling?
Well, you can have $100 billion sitting in a bank account, but you
Yeah.
can't just wave a magic wand and instantly materialize millions of complex microchips.
We still live in a physical world, right? We're governed by physics and manufacturing lead times.
And you have just identified the exact friction point that is driving this market vertical.
I like to picture it this way. Imagine you're building a massive state-of-the-art superhighway.
Okay, I'm with you. That highway represents the GPUs, those ultra-fast processors doing all the incredibly complex AI math. You're laying down 10 lanes in each direction. But then you realize the only way to actually get cars on and off this multi-billion-dollar superhighway are these tiny single-lane dirt roads.
Right, the on-ramps are bottlenecked.
Exactly. And if you don't upgrade the dirt roads, your superhighway is useless. It's just a very expensive parking lot.
That is the perfect analogy. In the semiconductor world, those single-lane dirt roads are memory chips and power management components.
Not the glamorous stuff.
No, but completely essential.
Mm-hmm.
A GPU processes data at incomprehensible speeds, but it needs a constant massive flow of data fed into it. And it needs incredibly precise amounts of electricity to run without literally melting.
Oh.
This physical bottleneck has created a phenomenon that industry analysts are now terming Memflation.
Memflation, I love a good portmanteau. But walk me through the mechanics of this. Why can't we just build more of these memory chips tomorrow to pave those dirt roads?
Because the specific type of memory required for these AI superhighways, it's called high bandwidth memory or HBM, is an absolute manufacturing nightmare.
Really? Why is it so hard to make?
You don't just print a single chip. You essentially have to manufacture several microscopic chips, stack them on top of each other like a skyscraper, and then punch microscopic holes vertically through all of them to connect the layers perfectly.
That sounds impossibly precise.
It is an engineering marvel.
Sure.
And because it is so difficult, the defect rates are high, meaning actual usable yields are low. According to our sources, HBM supplies are now completely sold out through the entire end of 2026.
Sold out, meaning if I'm a hyperscaler and I want to buy HBM today to finish my data center, I literally cannot. The inventory does not exist.
Exactly. And that scarcity causes violent pricing adjustments. As a result of this extreme supply-demand mismatch, standard DRAM memory prices have surged by 125%.
Wow.
And storage chip prices have skyrocketed by 234%.
So if HBM memory is completely sold out everywhere, the leverage in this market just violently shifted.
Oh, absolutely.
The hyperscalers have the checkbooks, but who actually holds the product? Who owns the toll booth on that single-lane dirt road?
That brings us to the Korean memory giants, specifically Samsung and SK Hynix.
I actually noticed a repeated reference in the research notes to something called Samsung shipping.
Yeah, the analysts clarified that. It's essentially industry shorthand acknowledging that Samsung and SK Hynix are almost entirely carrying the weight of this memory supercycle on their backs.
They control the supply side of the HBM bottleneck.
Right. Take SK Hynix, for example. They recently posted record-shattering first-quarter profits. And this wasn't a standard incremental corporate beat. It was an explosive jump driven purely by the pricing power they command right now.
Because they're the only ones making the skyscrapers?
Exactly. They are producing the exact microscopic memory skyscrapers that Amazon and Google are desperate for, and they can essentially name their price.
But it goes beyond just their corporate balance sheets. Our sources detail how these specific companies are actively warping the mechanics of the global ETF landscape.
Yes. Look at the newly launched Roundhill DRAM ETF.
Thematic funds. Right.
Yeah, it's a thematic fund specifically targeting memory chips. Within just 2 weeks of launching, it hit $1 billion in assets under management.
$1 billion in 2 weeks is blindingly fast capital formation. How does a fund that concentrated impact the underlying stock prices?
It creates a mechanical feedback loop.
Yeah.
That ETF is massively concentrated, roughly 23% in Samsung, 26% in SK Hynix, and 24% in the American company Micron.
That is extremely top-heavy.
It is. So when retail and institutional investors pour $1 billion into that ETF, the authorized participants running the fund are legally required to mechanically go out into the market and buy millions of shares of those specific companies.
Regardless of the current valuation.
Exactly. They don't have a choice. That massive forced buying pushes the stock prices even higher. The higher prices generate news headlines about a massive rally.
Which draws in the momentum traders.
Right, which brings more money into the ETF, forcing them to buy even more shares.
It becomes a self-fulfilling prophecy, at least as long as the money keeps flowing in. So the absolute dominance of the memory giants explains a huge part of why the rally broadened out beyond just the companies making the GPUs. But here's where it gets really interesting, because there is another hero in this 17-day rally.
Oh, yeah.
And honestly, it is a company I don't normally associate with flashy AI hype, Texas Instruments.
XN, the undisputed king of analog chips.
Right. Most of us think of them for those graphing calculators we used in high school calculus, but their Q1 2026 earnings report was the absolute catalyst that poured rocket fuel on this late April rally.
The numbers were phenomenal.
Let's look at the actual numbers. $4.83 billion in revenue, beating Wall Street estimates by a massive $453 million. Earnings per share came in at $1.68, completely crushing expectations.
Yeah.
But the most vital stat in their entire report was their data center revenue. It skyrocketed 90% year over year. I have to ask, why is a company known for analog technology seeing a 90% jump in an era dominated by advanced digital AI?
It's a great question. A digital chip just does math, ones and zeros. But an analog chip deals with the messy, volatile, physical world.
Like electricity.
Exactly. When an advanced AI server rack draws kilowatts of power in a split second to process an incredibly complex query, that massive power spike would instantly melt a standard motherboard. Texas Instruments builds the microscopic analog valves and power regulators that step down and manage that violent electrical current.
Yeah.
You cannot build a $100 billion AI data center without millions of tiny, incredibly cheap analog chips acting as the bouncers, basically making sure the whole system doesn't catch fire.
And the markets suddenly work up to that reality. The sources point out that following Texas Instruments' incredibly optimistic Q2 guidance, their stock jumped between 15 and 19% in a single day.
To put that in historical context, that was Texas Instruments' best single-day stock performance since the year 2000.
On the year 2000.
Yeah.
Anytime a financial analyst drops the year 2000 in a conversation about tech stocks, alarm bells start ringing. Are we partying like it's 1999, right before the dot-com bubble burst?
No.
Because if this is just an echo of that era, this does not end well for anyone holding the bag.
If we connect this to the bigger picture, it is a completely understandable fear. The dot-com era was characterized by massive semiconductor expansions built on speculative internet traffic that simply didn't exist yet.
Right.
Telecommunications companies were laying millions of miles of fiber optic cable for web startups that had zero revenue models.
The classic build it and they will come strategy where nobody actually showed up to use the product.
Precisely. It was all speculation. But if we analyze the current AI-driven growth against that previous cycle, the foundation is completely different.
How so?
The hyperscalers are spending hundreds of billions not on a whim, but because they already have massive enterprise clients beating down their doors, demanding AI compute time. The shift we are seeing right now, the shift that Texas Instruments perfectly represents, is the transition from a GPU-dominant infrastructure to a full chain infrastructure.
Meaning it's no longer just about hoarding the main brain, it's about building out the entire nervous system to support it.
Exactly. The infrastructure demands are so intense that analog power management, signal processing, and high bandwidth memory have become just as central to the modern AI build-out as the companies actually designing the neural networks. We are looking at physical utility scaling to meet guaranteed demand, not just software speculation.
That makes the underlying fundamentals much clearer. But the mention of the dot-com bubble is the perfect pivot because we cannot analyze a 40% run-up without looking at it through the lens of a risk-aware financial analyst. Nothing goes straight up forever, right?
Oh.
And earlier this year, the macroeconomic picture was actually quite dark. Let's talk about geopolitics.
We have to remember that semiconductor supply chains are arguably the most fragile and globally intertwined manufacturing networks in human history.
They really are.
Early in 2026, severe U.S.-Iran tensions flared up. While the broader market immediately focuses on crude oil prices when the Middle East destabilizes, the semiconductor industry was intensely focused on a completely different resource: helium.
Helium. We are talking about the same element used in party balloons.
The very same, but refined to intense industrial purities. Helium is an absolutely crucial inert gas used in chip manufacturing, particularly for advanced cooling and creating highly controlled environments during the fabrication process.
I had no idea.
Yeah. The geopolitical fears over energy spikes and potential helium supply chain disruptions briefly suppressed the entire semiconductor market in February and March.
But then, the geopolitical weather changed dramatically. According to the reports, in early April, Donald Trump announced a ceasefire brokered by Pakistan. And just as a quick aside for you listening, we are strictly impartially reporting the chain of events here from our sources, not taking any political sides whatsoever. But the sources note that the moment that specific geopolitical de-escalation was announced, the financial markets reacted violently.
They absolutely did.
Walk me through the mechanism of why a ceasefire thousands of miles away causes a semiconductor ETF to surge.
It triggered a textbook risk-on rotation.
Risk on!
Yes. When the helium supply chain was under threat, portfolio managers panicked. They parked billions of dollars in safe haven defensive assets, things like utilities or gold.
Just to protect the capital.
Right. But the moment the ceasefire was announced, the perceived supply chain threat vanished. Those portfolio managers suddenly had to put that sideline capital back to work in growth assets.
Because they need the yield.
Exactly. And because the AI supercycle was the most compelling growth story on the board, that capital acted like rocket fuel hitting the semiconductor sector all at once, perfectly coinciding with those massive earnings reports from companies like Texas Instruments.
It was the perfect storm of sidelined capital meeting undeniable fundamental growth. So we have the catalyst and we understand the mechanics. But looking at the historical precedents in our stack of data, what actually happens after a streak like this?
Historically, if you isolate the data, when the SOX index goes on a winning streak of 9 days or more, there is an 87% chance of positive returns over the next 1 to 3 months.
Wow.
The momentum tends to be self-sustaining as institutional algorithms and retail traders continue to pile in.
An 87% chance of positive returns over the next quarter. If you are a trader, those are fantastic odds.
They are. However, the risk analyst view requires us to look at the magnitude of the move, not just the statistical probability of it continuing.
Right, context matters.
Historically, the average gain during those streaks was around 13%. We're currently sitting at a 40% gain in less than 3 weeks.
So we are flying in completely uncharted airspace.
We are. Technical indicators, like the RSI, the Relative Strength Index, which measures how rapidly prices are moving to identify if an asset is overbought or oversold, are showing record overbought levels for these chip ETFs. The valuations across the sector are incredibly stretched relative to their historical averages.
So what does this all mean if you are looking at this objectively, trying to manage actual money? What are the ultimate risk factors that could derail this 17-day vertical train?
First and foremost, simple profit-taking pressure. When institutional funds are up 40% in a single month, portfolio managers are strongly incentivized, and sometimes mandated, to sell a portion of their holdings to lock in those gains.
Which means selling.
Yes, that creates intense mechanical selling pressure. Second, the supply chain vulnerabilities we discussed haven't been solved. They are just dormant. Whether it's helium, neon gas used in lasers, or critical shipping routes, any disruption could instantly spook this overextended market.
And what's the third risk?
The ultimate risk is the hyperscalers themselves.
The bottomless checkbooks writing the checks for the AI metropolis.
Exactly. This entire 40% rally is predicated on the assumption that Amazon, Google, Meta, and Microsoft will continue to relentlessly spend hundreds of billions of dollars year after year.
Which is a huge assumption.
Huge. If they even hint at slowing down their capex in an upcoming earnings call, if they say, hey, we have enough infrastructure for now, the foundation of this entire rally shatters.
Which brings us to the practical takeaways for the long-term investors out there trying to navigate this landscape without getting burned. How do we synthesize all of this data for the listener?
The core takeaway is this. The structural AI supercycle is very real. The long-term trends remain completely intact because the physics of the situation dictate that supply simply cannot catch up to demand right now.
The single-lane dirt roads of high-bandwidth memory will take years of complex engineering to widen.
Exactly. So the fundamentals are solid.
The fundamentals are solid, but
But given the extreme record-breaking overbought conditions we've just detailed, a risk-aware investor shouldn't be buying blindly into the momentum right now.
Right.
The prudent approach is to step back and watch the upcoming macroeconomic data and individual earnings reports closely. Use those underlying business metrics as your actual entry and exit signals, rather than just chasing the FOMO of a 17-day vertical streak. Wait for the market to take a breath.
Let the EKG needle come back down and find its normal heartbeat again.
Exactly. The most expensive words in investing are, "this time is different." The technology is different, but the laws of market gravity eventually apply to everything.
Well, thank you all for joining us on this deep dive into one of the most fascinating market anomalies we have seen in decades. We have unpacked the hyperscaler checkbooks funding the AI metropolis, the Memflation bottleneck choking the supply lines, the unsung analog heroism of Texas Instruments, and the sheer scale of this 40% sprint. But I want to leave you with one final, lingering question to ponder on your own.
It's a big one.
We have talked extensively today about the arms race to build the physical infrastructure of AI. All these high-power GPUs, all this incredibly complex memory, all these microscopic analog valves. What happens to the semiconductor industry in 5 or 10 years when all these massive data centers are finally built out and the world transitions from the highly profitable phase of building the AI brain to simply using it?
That is the multi-trillion-dollar question hanging over the entire sector.
We will leave you to chew on that. Until next time.